Hi, everyone, and welcome to Bybit Margin Masters. I just wanted to expand upon the number one trading pattern that I use to make all my money in crypto. I call it the lowercase h pattern. I learned it from a friend of mine, but I never see anybody really talk about it. And it shows up everywhere on the charts, especially after dumps. And that's what I wait for. I don't try and make my money catching a large pump or a dump. I wait for them to happen, and then I make my money on the aftermath of that because it's a lot more predictable how the price is going to react. Now, this pattern is called the lowercase h pattern, and I'm going to show you exactly how I would trade this if this was happening right now. So you can see right here the price dumped, right? It dumps and then it bounces and it creates this upside down U shape. But if you include the dump, it looks like a lowercase h. Let me just draw that on there for you. So it comes down and then it bounces. And you see the lowercase h? That's the pattern that I'm always trading, and it almost always happens after a big price move. So you can set your watch by it. Now, the thing that you want to do, you don't necessarily have to catch this bottom down here, right? What you're aiming to do is catch this top and then short it as it retests this support. Because it comes down here, this sets the support, and then once you see that it bounces, you're going to wait till it comes up here and try to catch up around here and then short it, because for whatever reason, whenever price dumps, it'll bounce and then it'll usually retest the bottom or at least somewhere close to it. You know, sometimes it's up where this wick is, but you get the general idea. It's this pattern. And sometimes it'll break all the way through and you just get lucky. Now, the way that you identify how this is going to bounce, A, is going to be market sentiment, right? So the higher the bounce, the more bullish the market is. The lower the bounce, the more desperate and out of it bulls are, because they're not buying it back up after the dump, right? So you want positive market sentiment for a high bounce, and for a low bounce, it'll be negative market sentiment. Now, this is where Fibonacci is so powerful. You want to take your Fibonacci tool and you want to come from your swing high, which is up here, down to your swing low, which is down here. And you would do this before all this part happened. So let's just say we saw this dump and then it wicks back up and we see this wick. You're going to now say, okay, I'm going to pretend this is my bottom, because it may not be the bottom, but you can start analyzing, how things are going. So I'm going to say this is my bottom now, and I'm going to draw my Fibonacci from my swing high to my swing low, which is my bottom. Now, based off Fibonacci, the most common areas that it's going to bounce to are between 0.382 and 0.618. And I always draw this. This is like my golden zone to try to short from, right? So if you've seen any of my charts, you'll see this box. Now, look how price reacted, right? So like, let's say it came down here and then I saw that this wicked back up. So I can start to see that we're getting some support here, because this is basically getting rejected off this support and going back up for the bounce. So I'll draw my fibs, and then none of this has occurred yet. So I'll just start putting my short orders from 0.382, 0.5, 0.6. And again, I said it's off the sentiment that you feel in the market. So some of this is your gut feel. But generally, you would have been okay if you got an order right here at 0.382 on low leverage, because it came up a little higher than that, but then it came back down, because it almost always comes back down. So you don't necessarily have to worry about getting the best entry, but generally, the safer bet is to go with 0.5. Right? 0.3, there's a chance that it's going to fill your order and continue to bounce higher and then come down. But sometimes all it goes to is 0.3. So you're going to have to get a feel for it. But generally in this zone is where you want to be setting your short orders. Now, the other thing you can do is you can try and catch this bottom. If you feel good enough that this bottom is in, you could long here and then know that when it gets to this zone, sell out of your long and then short it back down. Like, I do that sometimes. It's a little riskier, because if you don't catch the bottom, it might just keep on dumping. It's a lot safer if the bottom's already established, because you know that this This pattern is a lot safer than this pattern, like just dumping. Dumping, you can get wrecked real hard trying to catch a knife. But on a bounce, it's a lot more solid to trust because usually price doesn't dump down and then just shoot straight back up. You can look all over the charts. You're never going to see, or very rarely going to see, that pattern happening. So what I want you guys to do is I want you to start going to the charts. The best one that I find is the 1 hour for these smaller ones, but you can find it on bigger time frames too. Like, look right here, you can see it. See the dump, and then it bounced. See, there's a big bounce. Technically, you could say this is it right here. This is the U, or you could just go with this bigger one. But it's on all the time frames. Like, you'll see it everywhere. And I can't believe that more people aren't talking about this because it's so prevalent. Like, it happens all the time. Now, the other one, I don't trade this one as much, but when price pumps up, sometimes you'll get it when you hit resistance. See right here? See, it pumped up and then it made this U shape here. So it's like an upside down lowercase h at this resistance. So you could play it this way too. Like, you'd wait for it to come up here and then you'd short and then you'd long here. And you just do your fibs how I showed you, but you do them upside down for the retracement. Because, you know, this is for a bounce and this is called a retracement when it price comes up and then comes back down. And for that, you would draw your fibs like from the swing low to the swing high right here. And see it bounce. Look, where did this come to? Right in the zone I told you. See this U, it came right down to 0.618. So that's right within the box that I showed you on this one. If you go back and look at the charts, that's the best way you're going to learn stuff like this. You go identify these patterns and go draw your fibs and see where it bounces to or where it retraces to every time. And you're going to realize that this purple box that I drew, that I draw all the time, that's the most common area that it's going to go. Now that you know that this pattern is occurring, now that you're able to identify it when it's occurring after a big price move, you're going to be able to long from here if you're feeling risky and short from here if you want to make a much safer trade. The short from here is a lot safer because we're using stop losses, guys. If you're out here trading without a stop loss, you're going to get wrecked. You always set your stop loss. If you realize you're getting stopped out too much, lower your leverage or widen your stop loss, which is your margin for error. But you always want to have one. So the worst case scenario here would be that it shot straight back up, but that almost never happens. So it's much safer to try and short than to try and catch this bottom and long. But like I said, if you're really feeling that the bottom is in based off historic support that you found over here, you can also try and long this and then short it. This is the lowercase h pattern. I've kind of patented it for this group, and it's one of the #1 things I talk about in here because it's what made me so much fucking money trading, and I want all you guys to be just as successful as I've been. So I hope this helped. I hope you learned something. If any of this doesn't make sense, feel free to DM me and I'll explain more. And y'all have a nice day and make a fuckload of money. Peace.